Stop everything you're doing right now. It's January 16th, 2026, and I need you to understand what just happened in the silver market in the last 3 hours. While you were sleeping, while most of America was still in bed, billions of dollars changed hands in what I can only describe as one of the most violent liquidity hunts I've witnessed in my 12 years of trading precious metals. This isn't just another dip. This isn't just normal market volatility. What we're seeing right now is the exact mechanism that separates professional traders from retail victims, and if you don't understand what's happening in the next few hours, you're going to be on the wrong side of what could be the biggest move in silver this entire year. Let me paint you the picture of what went down. At 3:23 a.m. Eastern, just before the London session really heated up and well before New York opened, silver was trading comfortably at 89.40. The tape looked clean. Volume was average. Nothing seemed unusual. And then at 3:47 a.m. it started. A cascade of selling that looked like pure panic hit the market. Within 17 minutes, silver dropped from 89.40 all the way down to $87.80. That's a 160 drop, nearly 2% of the entire value, gone in less than the time it takes to make a cup of coffee. But here's what you need to understand. And this is where most retail traders get destroyed. That wasn't panic. That wasn't fear. That wasn't some fundamental shift in the silver market. That was a surgical strike. That was a liquidity hunt. That was the big players, the sharks, the institutional money, the bullion banks going fishing for stops. And they caught billions, literally billions of dollars in stop losses got triggered at $87.80. I'm talking about retail traders who placed their stops just below $88 thinking they were being smart, thinking they were protecting themselves. Professional hedge funds who had algorithmic stops at key technical levels, even some smaller institutions whose risk management systems automatically sell when certain thresholds are breached. All of that money, all of those positions, got liquidated in that 17-minute window. And you know who was on the other side of those trades? The same players who engineered the drop. This is how the game works. This is the jungle. And if you don't understand that you're swimming with sharks, you're going to end up as food. Now, before you think I'm just ranting, let me explain the mechanism because this is crucial. Liquidity in markets works exactly like gasoline in a car. You can have the most powerful engine in the world, you can have a Ferrari or a Lamborghini, but without fuel, that car isn't going anywhere. The silver market is the same. The big institutional players, the ones who actually move billions, who can push price where they want it to go, they need liquidity to fuel their moves. And where do they get that liquidity? From you, from retail traders, from anyone who's positioned on the wrong side when they decide it's time to move. Here's the specific play that just happened, and I want you to really absorb this because it's going to happen again. The bullion banks knew, they absolutely knew, that there were massive clusters of stop losses sitting at 87.80. How did they know? Because they have access to order flow data that you and I will never see. They know where every major player has their stops. They can see the entire market structure. It's like playing poker when you can see everyone else's cards. So what do? They coordinate a sell program in the thinnest part of the market, early morning, low volume, before New York wakes up, and they push price down specifically to trigger those stops. When those stops get hit, it creates a cascade. The stops become market sell orders. Those market sell orders push price down further. That triggers more stops. Those trigger more stops. It's a self-reinforcing spiral that the banks themselves started. And they're buying every single ounce that panicked sellers are dumping. This is accumulation disguised as distribution. This is strength disguised as weakness. And this is exactly what I've been telling my subscribers to watch for. Now here's where it gets really interesting, and this is where you need to pay very close attention because the next few hours are critical. After that drop to $87.80, silver has been grinding. As I'm recording this at 6:47 a.m., we're trading at 88.15. We bounced about 35 cents off that low, but we haven't reclaimed $89 yet. And there's a very specific reason for that. The sharks are deciding right now whether they got enough liquidity at 87.80 or whether they need to make one more trip down to 86.40. Let me explain why 86.40 matters. If you pull up a chart and look at the market structure from the last 2 weeks, you'll see there's another massive cluster of liquidity sitting right at 86.40. These are stops from traders who bought silver at $85 thinking they were getting a great entry, and they placed their stops just below at $86 or $86.50. These are also stops from swing traders who are using the recent low as their line in the sand, and the total notional value sitting at that level is absolutely massive. We're talking billions more in potential liquidity. So the question every professional trader is asking right now is, did the banks get enough fuel at $87.80 to launch silver higher, or do they need to make one more run down to $86.40 to really fill the tank? And I'm going to tell you how we're going to know the answer. Watch the price action between now and the New York Open at 9:30 a.m. a.m. If silver can reclaim $89 and hold it into the US session, that tells me the accumulation at 87.80 was sufficient. The banks got their liquidity, they loaded the boat, and we're about to see a violent reversal higher. But if silver continues to grind sideways or starts to drift lower, especially if we break back below 87.80, then buckle up because we're going to 86.40. That's where the real hunt will happen. And here's what most people don't understand. Both scenarios are bullish. Let me repeat that because it's counterintuitive and it's going to save you from making an emotional decision. Both scenarios are bullish for silver. If we rip higher from here, great. The banks have their liquidity and they're ready to push for new highs. If we drop to 86.40 dollars first, even better. That's an absolutely gift entry for anyone who understands what's happening. Because when they sweep that final pool of liquidity, when they trigger all those stops at 86.40 and you see silver drop to $86 or even $85.50, that's not the beginning of a crash. That's the end of the accumulation phase. Let me give you a concrete example from history so you can see this pattern clearly. Back in August 2020, gold was trading around $2,030. It had just made new all-time highs. Everyone was bullish, and then overnight in a single session, gold dropped $100 to $119.30. Retail traders panicked. The financial media called it a correction. Everyone who had their stops at $119.50 or $119.75 got destroyed. And you know what happened next? Within 3 weeks, gold was back at $2,070, making new highs. That drop to $119.30 wasn't distribution, it was accumulation, it was a liquidity sweep. And the exact same pattern is playing out in silver right now. The reason I'm so confident about this, the reason I'm taking the time to record this at 6:47 in the morning instead of sleeping, is because I've seen this movie before. I know how it ends. And I want to make sure that anyone watching this doesn't get shaken out right before the big move. Because that's what the banks are counting on. They're counting on you seeing silver drop to $87.80 or potentially $86.40. They're counting on you getting scared. They're counting on you selling at the worst possible moment. And they're counting on accumulating your position at a discount before they launch this thing to new highs. Now let me explain why today specifically is so dangerous and so important. Today is January 16th, 2026. It's the third Friday of the month. That means it's monthly options expiration, OPEX. This is the single most volatile day of the month for silver and gold. Why? Because there are billions of dollars in derivative contracts that expire today at 1:30 p.m. Eastern. All of those call options and put options at various strike prices. They all settle today. And the market makers, the big institutional players who sold those options, they have a massive incentive to make sure those options expire worthless. Here's how it works. Let's say a retail trader bought call options at the $90 strike price. That means if silver closes above $90 today, that option is in the money, and the option seller has to pay out. But if the option seller can push silver down to $89 or $80 or $87, then that call option expires worthless, and they keep 100% of the premium. Multiply that by thousands of contracts, millions of ounces of notional exposure, and you're talking about billions of dollars in profit or loss based purely on where silver closes today. So the game being played today is this. The market makers are going to do everything in their power to pin silver at the level that causes maximum pain for option buyers. If there are huge clusters of call options at 90, 90 and 95, they're going to fight like hell to keep silver below $90. And if that means taking silver down to $87 or $86 to shake out weak hands and reset the technical picture, they'll do it without hesitation. This is not manipulation in an illegal sense. This is how derivative markets function. The players with the most information and the most capital control where price goes on expiration day. But here's the thing that gives me confidence. Silver has been in a structural bull market since early 2025. We're up over 140% from the lows. Industrial demand is at all-time highs. Supply deficits are real and getting worse. Central banks around the world are diversifying away from the dollar, and the macro backdrop, inflation, currency debasement, geopolitical instability, all of it points to higher precious metal prices. So while the banks can play their games on OPEX, while they can hunt stops and pin price for a day, they can't change the underlying fundamentals. And that's why I say this with complete conviction, silver is going higher. Not maybe, not hopefully. It's going higher because the math demands it. The only question is whether we go straight up from $88 or whether we make one more dip to $86 to fuel the move. Either way, by the time we look back at this moment in February or March, this morning's drop to 87 to 80 is going to look like an absolute gift. Now let me tell you about a concept that's going to revolutionize the way you think about trading. And this is something that took me years to fully understand. The concept is this. You have to enter the market when others are being forced out. You have to enter when others are losing. You have to enter where others have their stop losses. This is the single most important piece of trading wisdom I can give you, and it goes against every instinct you have as a human being. Think about it. When silver drops from $89 to $87.80 in 17 minutes, what's your natural response? Fear, panic, the urge to sell, the thought that maybe you were wrong, maybe silver is going to crash, maybe you should get out before it gets worse. That's human nature. That's how our brains are wired. We're programmed to avoid pain, to run from danger, to protect what we have. But in the markets, that instinct will destroy you, because the moments of maximum fear, the moments when it feels like the sky is falling, those are exactly the moments when the big money is accumulating. Warren Buffett has a famous quote, "Be fearful when others are greedy, and greedy when others are fearful." But most people think that's just a cute saying. They don't actually practice it. They can't. Because when fear is running through your veins, when you see your position down 5% or 10%, when you hear the financial media talking about corrections and pullbacks, it takes incredible discipline to do the opposite of what your instincts are screaming at you to do. But that's the game. That's the edge. That's how you separate yourself from the herd. You have to train yourself to see a drop to 87.80 and think opportunity. You have to see stop losses getting triggered and think, that's where I want to be buying. You have to see everyone else panicking and think, this is where wealth is transferred from the weak hands to the strong hands. I've built my entire trading career on this principle. Every time there's a violent move against the crowd, every time there's a stop hunt, every time there's a liquidation cascade, I'm watching to see where the smart money is accumulating. And right now at $88.15 silver, with the potential for one more dip to $86.40, this is exactly the kind of setup I live for. This is the kind of setup where you can enter a position that goes on to make 30%, 50%, 100%, while everyone who sold at $87.80 is watching from the sidelines kicking themselves. Let me give you the specific game plan I'm using today, and remember, this is not financial advice. This is just how I'm navigating this market based on 12 years of experience and access to data that most retail traders don't have. First, I'm watching $89 like a hawk. If we can reclaim $89 and hold it for more than 30 minutes, especially if it happens during the London session before New York opens, that's a very bullish signal. That tells me the accumulation at 87 to 80 was sufficient and we're ready to move higher. In that scenario, I would expect silver to test $91, $92 by this afternoon. Second, if we continue to grind sideways or drift lower, if we break back below $87.80, then I'm watching for the final sweep down to $86.40. And if we get that move, if I see silver briefly touch $86 or even $85.50, I'm going to be very aggressive on the buy side. Not with 100% of my capital, I'm not stupid, but with a meaningful position size that reflects the probability of this being the final shakeout before the real move. Third, I'm completely ignoring the noise today. I'm ignoring whatever CNBC says. I'm ignoring the Twitter traders who are screaming about silver crashing. I'm ignoring the perma bulls who say every dip is manipulation and the perma bears who say every rally is a trap. I'm focused purely on price action, volume, and the market structure. Those are the only three things that matter. And fourth, I'm prepared for extreme volatility around the 1:30 p.m. Eastern options expiration. That's when the real fireworks happen. That's when we'll see if the market makers successfully defended their key strike prices or if the bulls break through. The hour between 12:30 and 1:30 p.m. is going to be absolute chaos. Expect whipsaws, expect fake moves, expect the kind of volatility that makes you want to close your trading platform and walk away. But if you can stay calm, if you can stick to your plan, if you can see through the manipulation, that's where the opportunity is. Now let me zoom out and talk about why this matters in the bigger picture. Because this isn't just about one day of trading. This is about understanding where we are in the silver market cycle and what's coming in the weeks and months ahead. Silver had an extraordinary year in 2025. We went from the low 30s all the way up to $93 at the peak. That's a 140% plus gain in a single year. It was one of the best performing major assets in the entire world. And yet, if you talk to the average person on the street, if you ask them what they know about silver, most of them have no idea this move even happened. That's because we're still in the stealth phase of this bull market. The institutions know what's happening. The smart money knows what's happening. The people who study commodity markets and monetary policy know what's happening. But the mainstream, the retail public, the casual investor, they're completely oblivious. They're still focused on tech stocks and crypto and whatever the financial media is pushing, and that's perfect. because the real money in any bull market is made before the crowd shows up. Think about Bitcoin in 2016 and 2017. When Bitcoin was at $1,000 or $2,000, most people had never heard of it. The gains from $1,000 to $10,000 happened before your uncle at Thanksgiving was talking about crypto. By the time Bitcoin hit $20,000 and everyone knew about it, the easy money had been made. The same pattern played out in tech stocks in the late 1990s. The same pattern played out in gold from 2001 to 2011, and the same pattern is playing out in silver right now. We're at the stage where the chart looks incredible, where the fundamentals are screaming, where anyone paying attention can see what's happening, but the masses haven't figured it out yet. That gives us time, that gives us opportunity. But it also means we have to have the courage to act when no one else is. We have to be willing to buy when it feels uncomfortable, when the price is dropping, when the headlines are negative. Because by the time it feels comfortable, by the time everyone agrees that silver is going higher, the move will be over. Let me talk about the supply-demand fundamentals for a moment, because this is crucial context. The world has been running a silver deficit for 6 consecutive years. That means global consumption exceeds global production. We're drawing down above-ground inventories to meet demand, and those inventories aren't infinite. Every year that we run a deficit, the available stockpiles get smaller. Eventually, we hit a point where there simply isn't enough silver to meet industrial demand at current prices. And the demand side is accelerating. Solar panel production is exploding as countries try to transition to renewable energy. Every single solar panel requires silver. There's no substitute that works as well. Electric vehicle production is ramping up, and EVs use significantly more silver than traditional cars. 5G infrastructure is being built out globally, and that requires massive amounts of silver for the electronics and conductors. Medical applications, water purification systems, semiconductor manufacturing, all of it requires silver. Meanwhile, on the supply side, we're not bringing new mines online fast enough to meet this demand. Why? Because for the last 30 years, silver was kept artificially cheap. When silver was trading at $15 or $20 or even $25, it wasn't economic to develop new primary silver mines. Mining companies focused on gold or copper or other metals and treated silver as a byproduct. So the pipeline of new supply is basically empty. Even if silver stays at $90 and mining companies decide to develop new projects, those projects won't produce an ounce of silver until 2030 or later. It takes 5 to 10 years to bring a new mine from discovery to production. Do you see the setup here? Demand is accelerating, supply is constrained, inventories are declining, and the price is still only at $80. That's not a fundamental problem, that's a fundamental opportunity. The market hasn't fully priced in the reality of what's coming, and when it does, when the industrial buyers start to panic about supply security, when the investment community starts to wake up, the price is going to move in a way that feels parabolic. Now I want to address something that I know some of you are thinking. But what about manipulation? What about the big banks? Won't they just keep capping the price forever? This is a fair question, and it's something I get asked constantly. So let me give you my perspective based on years of watching these markets. Yes, there is manipulation in precious metals markets. This is documented. There have been fines. There have been lawsuits. JP Morgan paid nearly $1 billion for spoofing the gold and silver markets. This is not conspiracy theory, it's legal fact. But here's what people get wrong. Manipulation doesn't mean the price can never go up. Manipulation means the price moves are more violent, more volatile, and more engineered than they would be in a truly free market. The banks can cap rallies temporarily. They can engineer sell-offs to hunt stops. They can create the appearance of weakness when there's actually strength. But they can't stop the underlying fundamentals forever. They can't print more silver. They can't magically increase supply when there are deficits. They can't change the fact that industrial demand is real and growing. So what happens is this. The banks suppress price for as long as they can, accumulating physical metal at artificially low prices. But eventually, the physical market breaks away from the paper market. Eventually, premiums on physical silver get so high that the disconnect becomes obvious. Eventually, delivery demands overwhelm the available inventory. And when that breaking point comes, the price doesn't just go up, it explodes. Because all the suppression, all the manipulation, all the artificial capping just created a pressure cooker. And when the lid blows off, the move is violent. That's what I believe we're setting up for in 2026. The suppression mechanism is starting to fail. You can see it in the fact that silver has held above $85 despite multiple attempts to push it lower. You can see it in the fact that physical premiums remain elevated. You can see it in the fact that industrial users are getting nervous about supply and locking in long-term contracts. The pressure is building. And what happened this morning at $87.80, that wasn't the banks crushing silver permanently. That was them desperately trying to grab as much liquidity as possible before they lose control completely. Let me tell you about one more critical factor that most people are completely ignoring: the Shanghai premium. Right now, as I'm recording this, silver is trading around $88 in New York and London. But in Shanghai, the price is significantly higher. We've seen Shanghai premiums of $5, $10, even $50 per ounce above Western prices. Why does this matter? Because it tells you where the real demand is. Chinese buyers are willing to pay substantially more for physical silver than Western markets are pricing it at. That's not a small detail. That's a massive signal about what's actually happening in the physical market. The Shanghai premium exists because China is accumulating. Their industrial sector needs silver for manufacturing. Their government is diversifying reserves away from dollars. Their citizens are buying silver as a store of value. And because there are capital controls and import restrictions, silver that makes it into China trades at a premium to silver sitting in Western vaults. This creates an arbitrage opportunity for anyone who can physically move metal from west to east, and that arbitrage flow is draining Western inventories. Eventually, one of two things happens. Either Western prices rise to close the premium gap, or Western vaults get completely drained, and we have a supply crisis. Both scenarios are bullish. The first scenario means silver in New York and London rallies to match Shanghai prices. That's potentially 100 plus or silver in the near term. The second scenario means physical shortages, delivery failures, and a complete breakdown of the paper pricing mechanism. That's potentially 150 plus silver or higher as the market reprices based on actual physical availability rather than paper contracts. And here's the kicker. The big institutional players know this. The bullion banks know this. The hedge funds know this. That's why they're playing these games with stop hunts and liquidity sweeps. They're trying to accumulate as much physical metal as possible before the market realizes what's happening. Every time they push price down to $87.80 or $86.40, every time they trigger a cascade of stop losses, they're buying, they're accumulating, they're positioning for what's coming. So when I see silver drop $1.60 in 17 minutes, I don't see fear. I don't see weakness. I see opportunity. I see the sharks feeding, and I know that if I can position myself on the same side as the sharks, if I can buy when they're buying instead of selling when retail is panicking, I'm going to be on the right side of the move that follows. Now let me give you the practical takeaway, the actionable intelligence you can use right now. If you own physical silver, do nothing. Hold. This is not the time to panic. This is not the time to sell because you saw a $1.60 drop. Your physical silver is your insurance policy, your monetary hedge, your protection against currency debasement. You don't sell insurance the day before the hurricane, you hold it. If you're looking to add to physical holdings, wait and see if we get that final dip to $86.40. If we do, that's your entry. That's your chance to buy at a level we may never see again. If you trade silver futures or mining stocks, here's the level I'm watching. $87.80 was the first liquidity hunt. If we reclaim $89 and hold, we're probably done going down and ready to move higher. But if we break back below $87.80, then $86.40 is the target. At that level, I would be a very aggressive buyer with tight stops. Why? Because if they sweep $86.40 and we don't get follow through to the downside, if we bounce hard off that level, it confirms that was the final liquidity grab. That was the bottom of this consolidation. And the next move is significantly higher. For mining stocks specifically, remember the operating leverage I explained in my previous video. These companies have all-in sustaining costs around $30, $40 per ounce. At $88 silver, they're printing money. At $100 silver, they're printing obscene money. At $120 silver, their profit margins will be unlike anything we've seen in a decade. And yet the stocks are still priced as if silver was at $50 or $60. That disconnect is the opportunity. That mispricing is where generational wealth is made. Here's what I'm watching in mining stocks today. I want to see relative strength. If silver drops to $86.40 and the mining ETFs only drop half as much, that's bullish. That's the market telling you that despite the commodity pullback, the companies themselves are being revalued. That's the beginning of the catch-up rally. And when that catch-up rally accelerates, when the institutions start rotating capital into precious metals miners, the moves are going to be violent. We're talking 20%, 30%, 50% gains in individual names over a matter of weeks. But you have to have the stomach for it. You have to be able to watch your positions go down before they go up. You have to be able to hold through the volatility. Because the banks are going to do everything they can to shake you out before the real move. That's their business model. That's how they make money. They accumulate from weak hands and sell to strong hands at higher prices. Your job is to make sure you're a strong hand. Your job is to not give them your shares at $87.80, only to watch silver go to $110 over the next 3 months. Let me talk about the geopolitical dimension for a moment because this adds massive fuel to the silver thesis. We're living through a fundamental restructuring of the global order. The post-World War II framework dominated by US dollar hegemony is fracturing. You can see it in Trump's tariff policies. You can see it in China's rare earth export restrictions. You can see it in the Shanghai Cooperation Organization creating alternative payment systems. You can see it in central banks around the world, diversifying reserves away from dollars and into gold, and increasingly into silver. This isn't speculation. This is observable reality playing out in real time. The BRICS nations are actively working to create alternative settlement currencies. Saudi Arabia is selling oil in yuan, India is buying Russian oil in rupees, the European Union is creating digital euro infrastructure that could eventually bypass the dollar. Every one of these developments weakens dollar dominance, and when dollar dominance weakens, hard assets strengthen, gold, silver, commodities, real tangible things that can't be printed by central banks. Silver specifically benefits because it serves dual purposes. It's both an industrial metal and a monetary metal. If you're a country trying to diversify away from dollars, gold is the obvious choice. But gold is expensive and your industrial sector doesn't need it. Silver gives you monetary diversification and industrial utility. You can stockpile silver for reserve purposes while also using it for manufacturing, for technology, for infrastructure development. That dual demand is what makes silver uniquely positioned in this new world order. And here's something most people haven't thought about. What happens if a major economy remonetizes silver? What if India, with 1.4 billion people, allows silver to be used in pension accounts or as bank collateral on a wide scale? What if a Latin American country, maybe Mexico or Peru, decides to back their currency partially with silver? The amount of silver that would need to be acquired for those systems to function would be absolutely staggering. We're talking about demand that dwarfs current industrial consumption. This isn't far-fetched. India already started allowing farmers to use silver as direct collateral for bank loans in March 2025. That's functional remonetization, even if it's not officially labeled as such. If that program expands, if it goes from agricultural loans to business loans to mortgages to pensions, you're talking about a demand shock that the market is completely unprepared for. And that demand can't be met at $80 silver. It probably can't be met at 120 silver. The price would have to go significantly higher to incentivize enough new supply and recycling to meet that kind of demand. So when I look at what happened this morning, when I see silver drop to 87.80 and retail traders panic selling, I see people who are focused on the wrong time frame. They're looking at hourly charts and daily volatility. They're not seeing the multi-year bull market. They're not seeing the supply deficits. They're not seeing the monetary transition. They're not seeing the geopolitical realignment. They're reacting to noise instead of understanding the signal. The signal is clear. Silver is going higher. The fundamentals demand it. The math requires it. The only question is the path we take to get there, and whether that path includes one more dip to 86.40 or whether we've already seen the low at 87.80, the destination is the same. Higher, significantly higher. And anyone who allows themselves to get shaken out by short-term volatility is going to miss the opportunity of a lifetime. Let me give you one final piece of advice, and this might be the most important thing I say in this entire video. Trading and investing is 90% psychology and 10% strategy. The strategy is easy. Buy low, sell high, follow the trend, manage your risk. A 12-year-old could understand that. But the psychology, the ability to actually execute when your emotions are screaming at you to do the opposite, that's what separates winners from losers. When you see silver drop 160 in 17 minutes, you're going to feel fear. That's normal. That's human. But you have to train yourself to question that fear. Is this fear based on fundamental change, or is this fear based on short-term price action? Did something fundamentally change about silver's supply-demand outlook in those 17 minutes? Did industrial demand suddenly evaporate? Did new mines suddenly come online? Did central banks suddenly stop buying? No, none of that happened. The only thing that happened was price moved down because large players were hunting stops. So the rational response is to recognize that this is noise, not signal. This is a temporary shakeout, not a trend change. This is an opportunity, not a crisis. But making that rational assessment when your account is showing red, when your heart is pounding, when that little voice in your head is saying, get out before it gets worse, that takes discipline, that takes practice, that takes experience. And that's why I'm making this video, because I've been there. I've felt that fear. I've made the mistake of selling at the worst possible time because I let emotions override analysis. And I've learned, painfully, that the only way to succeed in these markets is to develop the psychological strength to do what's right even when it feels wrong, to buy when others are selling, to hold when others are panicking, to add when others are cutting. That's the edge. That's the alpha. It's not some secret indicator or proprietary algorithm. It's the ability to see what's happening, understand the mechanism, and position yourself on the right side before the crowd figures it out. And right now, at 7:23 a.m. Eastern on January 16th, 2026, with silver trading at $88.15 after a brutal drop to $87.80, I'm telling you that the right side is long. The right side is bullish. The right side is positioned for higher prices. Will we see $86.40 first? Maybe. I'm prepared for that possibility, but whether we do or don't, the destination is the same. $100 silver is coming, $120 silver is probable, and 150 plus size silver is possible if we get the kind of supply crisis or monetary transition that the fundamentals suggest is building. The opportunity is right in front of you. The market just gave you a gift this morning by dropping price and shaking out weak hands. The question is, are you strong enough to take advantage of it? Stay disciplined, stay focused, and remember, you enter where others are exiting. You buy where others have their stops. You accumulate when others are liquidating. That's how this game works. That's how wealth is transferred. And that's how you position yourself to profit from what I believe is going to be one of the greatest commodity moves of this decade. The sharks are feeding. Make sure you're swimming with them, not running from them.